Hey, welcome to this week's video. Cryptocurrencies have gone mainstream. For example, you can use Bitcoin to buy far more than you think. Try Googling, what can I buy with Bitcoin? And you'll get more than 350,000 hits. But using cryptocurrencies has federal income tax implications that may surprise you. With the price of Bitcoin having gone through the roof and then down, and with the increasing acceptance of Bitcoin and other cryptocurrencies as forms of payment, the tax implications of using cryptocurrencies are a hot button with the IRS right now. In this video, I'm going to discuss what you need to know about cryptocurrencies so you can stay out of the way of the IRS's relentless pursuit of getting a handle on cryptocurrency transactions. Cryptocurrency is the digital money usually issued and controlled by software developers and accepted as payments by willing parties. Also known as virtual currencies, cryptocurrencies can be transferred, stored for future use, held for investment, or traded electronically. Bitcoin is a good example and a well-known example. Unlike conventional currencies such as the US dollar or the euro, cryptocurrencies are essentially unregulated. It's actually the Wild West right now. The most common way to obtain cryptocurrency, such as Bitcoin, is through a cryptocurrency ATM or online exchanges, which typically charge a very nominal transaction fee. Some businesses now are happily accepting payment in cryptocurrencies. In fact, some NFL players are asking to be paid in cryptocurrencies. Though cryptocurrencies are basically unregulated, every cryptocurrency transaction is digitally recorded in a distributed public ledger, such as blockchain. Anyone can download actually a copy of the blockchain transactions to trace the cryptocurrency transactions. A distributed ledger technology uses independent digital systems to record, share, and synchronize transactions, the details of which are recorded in multiple places at the same time with no central location of where those transactions are. Actually, there's no central oversight currently of cryptocurrency. Like the Fed that oversees the money supply, that does not exist in the cryptocurrency world. The 2020 version of the 1040 asked whether you received, sold, exchanged, or otherwise acquired at any time during the year any financial interest in any virtual currency. If you did, you're supposed to check the box yes. The fact that this question appears on the front page of the 1040 towards the top, right below basically the name and address, indicates that the IRS is very serious about enforcing compliance with the applicable tax laws as it relates to cryptocurrency. The 2020 Form 1040 instructions clarify that virtual currency transactions, for which you should go ahead and check that box yes, include the receipt or transfer of virtual currency for free, the exchange of virtual currency for goods or services, the sale of virtual currency, the exchange of virtual currency for other property, and the disposition of a financial interest in a virtual currency. The IRS takes a position that cryptocurrency is property for income tax purposes. Because it's property, you recognize and report gain or loss when you exchange cryptocurrency for goods or services, US dollars or euros, different cryptocurrencies, or any other type of exchange. If you fail to report cryptocurrency transactions on your 1040 and you get audited, you could face interest and penalties, and in some extreme cases you might actually face criminal prosecution. To arrive at the federal income tax results of cryptocurrency transactions, the first step is to calculate the fair market value, and that's measured in US dollars, of the cryptocurrency on the date you receive it and the date you use it to pay for something or exchange it. The current value of the most popular cryptocurrencies are listed on exchanges. For example, Bitcoin or other cryptocurrencies are listed on the Coinbase exchange. So if you bought one Bitcoin with US dollars of say $55,000, your basis in the Bitcoin for federal income tax purposes is going to be $55,000. You will have a taxable gain if the fair value of what you receive exceeds the basis in the cryptocurrency that you exchanged. Likewise, you'll have a taxable loss if what you receive is less than your basis in the cryptocurrency. The taxable gain or loss from exchanging a cryptocurrency will be a short-term or long-term capital gain or loss depending on how long you held that cryptocurrency before using it in a transaction. So let's look at an example. Let's say that you buy one Bitcoin for $31,000. Now the value has gone up to $55,000. Then you decide that I'm going to use that Bitcoin to buy some supplies in the business for $55,000. Well, you now have a deduction for the supplies that you purchased, and you have a taxable gain of $24,000, which is the difference between what it's worth when you bought those supplies and the basis of when you initially bought the Bitcoin. If you use cryptocurrencies to pay employee wages, the fair market value of the currency counts as wages subject to federal income tax withholding, FICA tax, and FUTA tax. And this may sound a bit weird to pay wages in cryptocurrencies, but as I mentioned earlier in the video, there are people that are actually NFL players that are asking to be paid in cryptocurrency. So this is coming. So as with any other wages paid to employees, you must report the wages to the employees on your W-2, and you must also file all the payroll tax returns. If you use cryptocurrency to pay an independent contractor for performing services in your business, it's the same thing. The fair market value of the currency is subject to the payment, and also as an independent contractor, that is then subject to self-employment tax for that independent contractor. Also, you're required to report the payment on form the 1099 that you do every year for the vendors if that payment actually exceeds $600. As explained earlier, you may also have a tax gain or loss due to the appreciation or decline in the value of the cryptocurrency during the time period you held it before paying out the wages or services to that independent contractor. The gain or loss will be a capital gain or loss, and will be short-term or long-term, depending on how long you held that cryptocurrency. So let's look at an example. Let's say that you're a self-employed professional taxed as a sole proprietor. That means that you report your business in your 1040 on your Schedule C. You accept one Bitcoin as payment. Bitcoins are worth at the time $55,000, and that's according to the Coinbase exchange. And that means that you're required to recognize on your Schedule C $55,000 of income for the services. The $55,000 is also subject to self-employment tax. And what you want to do in this case is you want to keep evidence of the value of that cryptocurrency on the date that you got paid, in case you ever did get audited. So what are some takeaways from this video? Well, if anything, I would like for the takeaway to be to keep detailed records, and those records are essential for your cryptocurrency transactions. They should include the date on which you received the cryptocurrency, the fair market value on the date of receipt, the fair market value on the date you exchanged it for US dollar, and the cryptocurrency trading exchange that you use to determine the fair market value for purposes of the exchange or the timing of the exchange that you did. And also note whether it was personal or business use would be good. With this information, you or your tax pro can determine the federal income tax consequences for these cryptocurrency transactions. And yes, don't forget about the state tax consequences as well. Well, that's it for this week's video. If you got any value out of it, it'd be great if you hit that thumbs up. And if you haven't subscribed, it'd be great to have you as a subscriber. Okay, until next time, we'll talk to you later.